Well, in truth, most of the clients of SVB are startup companies that burn cash, on a regular basis. So, in essence, they are drawing down regularly as a regular course of their business. I think business conditions have been a little bit worse of late. Revenues are lighter, and so the burn rates of some of these companies have gone up, and so there was probably more drawdown. Plus, there was some general fear in the market. And there was obviously what happened last week, which was where people were actually afraid of Silicon Valley Bank collapsing, and that's when the real run on the bank occurred. But I think as an ordinary course of business, they do have regular drawdowns from their customers.
But in terms of your portfolio companies, are you worried at all about the cost of credit moving forward? Because I would imagine that this has to change how SVB approaches its relationships, at the very least, with a lot of its customers? Or from what you're hearing, is it just a matter of the same kind of terms, the same kind of conditions, the same kind of risk that is being taken on?
No, we're very worried. Firstly, there's great uncertainty. A lot of our companies, had regular lines of credit, term loans, account receivable loans with Silicon Valley Bank. They service a very large percentage of the market. And so we're just not sure whether that capital is going to be available. I think overall there's going to be a general credit tightening because there's a real fear, a systemic fear overall in the economy, whether it's the banking sector or beyond. And so we were already seeing, some tightening of credit. Now we have a big player, that serviced over half of the industry removed. It's still there, but we're not sure what the future will be for Silicon Valley Bank. And so I think we're at a very scary moment where we're just not sure, what the future lines of credit will be for, startup companies that we work with.